Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, April 7th, 2026. This was a mixed, cautious tape that traded like it wanted to break, and then got rescued late. The whole day pivoted around Iran and Strait of Hormuz risk, potential oil shock versus risk assets. Stocks slid early, then ripped late as de-escalation chatter hit. We finished slightly green in spots, but the session felt fragile, totally headline-led. On the S&P 500 heatmap, you could feel the stress, more red than green, but nowhere close to a full-on wipeout. The big visual drag was Apple, one huge deep red box pulling on the whole index vibe. Offsetting that, energy showed broad green support, and healthcare popped thanks to a bright green UnitedHealth. And then you had a small pack of leaders, names like Google and AVGO, doing a lot of work to keep the index from looking worse. That heat map split lined up cleanly with sector rotation. Money hid in energy as a direct way to play geopolitics and elevated crude risk. Healthcare caught a bid too, not really about the macro, more about policy, with Medicare Advantage rate news powering the group. Tech wasn't broad, it was selective. AI infrastructure winners like AVGO and a few semiconductor pockets. Where did money leave? The consumer space. When staples and discretionary are both red at the same time, it reads like stress, not just a neat little factor shift. Zooming out, the real tell wasn't the final print, it was the path and the dispersion. This traded like a market that wanted to de-risk first, then got a late geopolitical pressure release. But capital didn't rush back into broad beta. Instead, a handful of mega and near-mega names drove the emotional tape. Apple on the downside, and AVGO, UNH, and Google on the upside. That's narrow leadership, and it keeps traders jumpy because being wrong in one big ticker can matter more than being right on the index, On the chatter front, the market traded like it was reacting to every whisper around Iran, especially talk of a ceasefire window, or deadline extensions tied to the Strait of Hormuz. None of that should be treated as fact in real time, but it clearly shaped behavior. Risks sold first, then snapped back when the perceived temperature dropped. Classic headline tape, fast flips, low conviction, traders glued to alerts. Broadcom was the clean, confirmed upside story. AVGO jumped a bit over 6% after news of a long-term deal with Google to develop and supply custom AI chips through 2031. In a tape dominated by Geopolitics, this traded like a little risk on island, one of the few places investors could point to a clear catalyst. It also helped keep semiconductor sentiment from cracking, even while the broader market felt shaky. Apple was the gravitational pull on the downside. Apple fell just over 2%, and the heat map made it obvious. This was the big red weight that made the whole session feel heavier than the index close suggested. The move tied back to negative company-specific headlines around product and engineering delays, including reports of foldable iPhone setbacks layered on top of a market already sensitive to geopolitical and inflation risk. UnitedHealth was the other high-signal move. UNH surged almost 4% after CMS finalized 2027 Medicare Advantage payment rates, with an average increase just under 2.5%, better than earlier proposals. That's the kind of policy surprise that can re-rate managed care in a hurry. And in this environment, it reinforced the playbook. When headlines get messy, investors lean into defensives with a clear, idiosyncratic tailwind. Alphabet was one of the key green generals. Google gained just under 2%, helped by the Broadcom partnership headline and the broader AI build-out story. On a day when Apple was a major anchor that mattered, it's a big reason the index could look okay on the surface, even while a lot of the board stayed heavy underneath. Walmart was a loud signal from the defensive consumer side, just not the kind bulls want. Walmart dropped more than 3%, with reports tying the move to retailer margin and cost worries in a tougher macro and tariff backdrop. When a staples anchor like this turns into a bright red outlier, it undercuts the idea that investors are simply hiding in safety. It also helps explain why the Dow struggled to fully join the late bounce. Chevron captured the day's energy bid. CVX rose a bit over 1% as crude stayed elevated with Strait of Hormuz risk in the background. Even as late de-escalation chatter lifted equities, energy held up, acting as both an inflation hedge and the market's most direct geopolitical expression. The key takeaway on positioning, traders weren't piling into broad cyclicals, they kept a foot firmly in the hedge. Looking ahead, the near-term driver is still geopolitical headlines, any updates on an Iran ceasefire window, or on Strait of Hormuz shipping and enforcement details. Second, watch the mechanics. After a late-day reversal like this, markets usually test whether there's follow-through or a fade at the next open. On the calendar in this setup, next week's key U.S. data includes PPI on Tuesday, April 14th at 8:30 a.m. Eastern, and Philly Fed plus jobless claims on Thursday, April 16th at 8:30 a.m. Eastern. So the story today was straightforward. Big intraday fear, late relief, and an index close that hit a lot of underlying tension. Energy and healthcare led, select AI infrastructure popped, but consumer weakness and Apple's drag kept the tape feeling heavier than the final numbers. Into the next session, keep it qualitative. Watch the headlines, watch whether leadership broadens, and watch whether the biggest weights, especially Apple, stop leaning on the market. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.